Scene script. Have you ever wondered why central banks are accumulating gold at the fastest pace on record in 2023? It's a fascinating phenomenon, one that is sure to have multiple implications for the world economy. Let's dive into the details. According to a recent report by the World Gold Council, central banks have been on a veritable buying spree, snapping up a net of 125 tons of gold in just the first 2 months of this year. This marks the highest amount for any year since banks became net buyers in 2010. Now you may be curious which countries are leading in this gold rush. Topping the list is Singapore, having added a whopping 51.4 tons to its reserves. Following closely behind is Turkey, with 45.5 tons. Then we have China, a global economic powerhouse, adding 39.8 tons to its stash. Russia, not one to be left out, has accumulated 31.1 tons, and India, despite its relatively smaller purchase of 2.8 tons, still plays a significant role due to its massive consumer market for gold. So why this sudden rush for gold? Well, gold has always been viewed as a safe haven during times of economic uncertainty. And with the world economy still reeling from the effects of the pandemic and geopolitical tensions, it's not surprising that central banks are choosing to shore up their reserves with the yellow metal. But there's more to this story. The gold accumulation by central banks is not just about economic security. It's also a strategic move, a hedge against inflation, and a way to diversify foreign exchange reserves. This gold rush by central banks is a complex and intriguing trend that needs to be closely watched. This unprecedented gold accumulation by the central banks is a trend that demands our attention. And as we follow this story, we'll keep you updated with the latest developments and what they mean for the global economy and your investments. So what do these numbers really mean for the global economy? Well, let's dive into that. The World Gold Council reports that central banks have collectively bought a net 125 tons of gold in the first 2 months of 2023. This is the highest amount for the year since banks became net buyers in 2010. Now let's break that down. The top 5 countries reporting the most significant purchases were Singapore, Turkey, China, Russia, and India. Singapore led the charge with 51.4 tons, followed closely by Turkey with 45.5 tons. China wasn't far behind with 39.8 tons. Russia weighed in with 31.1 tons, and India, while lagging behind the others, still made a notable contribution with 2.8 tons. These are not just arbitrary numbers. They have significant implications for the global economy. Gold is traditionally viewed as a safe haven asset. In times of economic uncertainty or instability, investors often turn to gold as a reliable store of value. So the fact that central banks, the guardians of national economies, are stocking up on gold at such a rapid pace suggests a level of caution in the face of potential economic turbulence. Furthermore, these purchases aren't evenly distributed. The countries making the largest acquisitions, such as Singapore, Turkey, and China, are those with emerging economies. This suggests a strategic shift towards building up gold reserves as a buffer against economic shocks and as a tool for international diplomacy. Lastly, the sheer volume of these purchases is worth noting. A net of 125 tons in just 2 months is a significant amount. This suggests that central banks are anticipating a higher demand for gold in the future, which could potentially drive up the price of the precious metal. So, what's the takeaway here? The implications of these purchases are far-reaching and could potentially reshape the global financial landscape. This gold rush by central banks signifies a cautious approach to a future filled with economic uncertainty and highlights the enduring value of gold in the global economy. Now let's delve into the insights of renowned economist Alastair Macleod. Macleod's astute observations on the recent surge in gold buying by central banks have been turning heads. He's not just looking at the numbers, he's delving deeper into the why and the how. His perspective, it's not just about economics, it's also about geopolitics. Macleod highlights a fascinating trend, the substantial interest in gold from regions like the Middle East. This isn't a coincidence. Macleod links this to the historical tensions between these regions and Western powers, particularly the United States. He suggests that these geopolitical undercurrents might be driving a shift towards gold as a safe haven asset. But why gold? Well, Macleod explains that gold has always been seen as a store of value. In times of uncertainty, when trust in fiat currencies wavers, gold's intrinsic value shines. It's a hedge against the unpredictable, a safety net in a world of economic and political volatility. In Macleod's view, the surge in gold buying isn't a flash in the pan. It's a sign of a deeper shift in the global economic landscape. Countries are looking for stability and security, and they're finding it in gold. But Macleod doesn't stop there. He also points out that this trend isn't confined to central banks. Private investors, corporations, even individuals are all showing an increased interest in gold. This, he suggests, is a reflection of a broader trend, a growing awareness of the potential of gold as a means of preserving wealth in uncertain times. So, what does this all mean? Well, according to Macleod, it's a wake-up call. It's a signal that we need to pay attention to the changing dynamics of the global economy. It's a reminder that in an unpredictable world, gold remains a reliable constant. Alastair Macleod's analysis provides a thought-provoking lens through which to view the current gold rush. His perspective offers us a deeper understanding of the forces driving this trend and the potential implications for the future of global finance. But central banks are just one part of the gold market. Indeed, the world of gold is far more diverse and intricate than it appears at first sight. Beyond central banks, a myriad of other players significantly contribute to the dynamics of this precious metals market. Let's delve into this broader picture. In the realm of gold, we find private investors, both large and small, who purchase the metal as a form of wealth preservation or for speculative purposes. From tech industry billionaires to humble coin collectors, the allure of gold transcends economic status and geographical borders. These private investors can cause significant shifts in gold prices, especially during times of economic uncertainty. Then we have the jewelry industry, a major player in the gold market. In fact, it accounts for about half of the global demand for gold. In countries like India, gold jewelry is not just a fashion statement but a cultural tradition deeply ingrained in society. Seasonal patterns in the jewelry industry, such as the Indian wedding season or the Chinese New Year, can greatly impact gold prices. Mining companies too play a vital role in the gold market. Their activities determine the supply of new gold entering the market. Changes in mining output, whether due to technological advancements or environmental regulations, can have a profound impact on gold prices. Finally, we cannot forget the role of financial markets. Gold is heavily traded as a commodity on exchanges around the world. Futures contracts, exchange-traded funds, and other financial instruments tied to the price of gold add another layer of complexity to this market. This broader view of the gold market shows us that while central banks certainly play a significant role, they are just one piece of a much larger puzzle. Numerous factors influence gold prices, from geopolitical events to technological innovations, from cultural traditions to market speculation. Understanding the wider gold market is crucial to predicting future trends. After all, in the world of gold, everything is interconnected, and every player, no matter how small, has a part to play. Now, let's take a look at the current market trends and predictions. As we delve into the world of gold, silver, and copper, it's clear that these markets are a hive of activity. Gold, often seen as a safe haven in times of economic uncertainty, has been experiencing a surge in demand, fueled by central banks' accelerated buying spree. This trend is expected to continue as geopolitical tensions and economic uncertainties persist. Therefore, expect gold prices to remain firm in the coming months. However, keep in mind that gold markets are notoriously volatile and can be influenced by a myriad of factors. So it's always wise to stay informed and flexible. Moving on to silver, the market trends reveal a different story. Unlike gold, silver has a significant industrial use component. With the global economy recovering and industries ramping up production, the demand for silver is expected to rise, potentially pushing prices higher. But remember, this market is also subject to volatility and external influences, so keep an eye on global industrial trends and economic indicators. Now let's turn our attention to copper. Often referred to as Dr. Copper due to its ability to predict economic trends, copper has been in high demand, particularly in the renewable energy and electric vehicle sectors. This, coupled with supply constraints, has led to a surge in copper prices. Looking ahead, if the push towards green energy continues at its current pace, copper prices could continue their upward trajectory. However, like with any commodity, it's important to monitor global supply and demand dynamics. As we look forward to the coming months, remember that these predictions are based on current market conditions and trends. Markets are dynamic and can change rapidly due to external factors. Therefore, it's crucial to stay informed, regularly review your investment strategy, and adapt to changing market conditions. These trends and predictions can help investors make informed decisions. So, how can you navigate this dynamic market? As we've seen, gold and other precious metals continue to play a critical role in global economics. But how can you, as an investor, leverage this information to your advantage? Let's delve into a few strategies that might help you make informed decisions. First, consider diversifying your portfolio. This is a fundamental principle in investment, and it's especially relevant when dealing with such a volatile market. You don't want to put all your eggs in one basket. Instead, spread your investments across different assets. Allocate a portion of your portfolio to gold and other precious metals, but also consider other sectors like stocks, real estate, and even cryptocurrencies. Second, become a student of the market. Knowledge is power in the world of investment. Stay updated with the latest trends, watch the movements of central banks, and keep an eye on geopolitical events. These can all impact the price of gold and other assets. Third, consider long-term investments. While it can be tempting to jump on short-term trends, remember that investment is a marathon, not a sprint. Gold, for instance, has consistently held its value over time. It may not offer the quick returns of some other assets, but it provides a measure of security that's hard to beat. Fourth, don't be afraid to seek professional advice. Investment can be a complex field, and it's always helpful to have an experienced guide. A financial advisor can provide personalized advice based on your financial goals and risk tolerance. Lastly, remember the golden rule of investment. Never invest more than you can afford to lose. Markets can be unpredictable, and even the best-laid plans can go awry. Always keep a safety net and invest responsibly. These strategies are just the tip of the iceberg. The world of investment is vast and varied, and there's always something new to learn. So keep exploring, keep learning, and keep investing. With the right strategy, you can make the most of the opportunities in this market. Now let's catch up with the latest industry news. In the gold sector, the World Gold Council reports an unprecedented surge in demand. Central banks worldwide, particularly in Singapore, Turkey, China, Russia, and India, have been net buyers of the precious metal. Their combined purchase of a staggering 125 tons in the first 2 months of 2023 alone has set a new record. This trend underscores gold's enduring appeal as a secure and stable investment in uncertain times. Moving on to silver, the Silver Institute forecasts a positive outlook for the year. Industrial demand is expected to rise significantly, driven by the growing need for silver in various applications, from electronics to renewable energy. In particular, the photovoltaic industry, which relies on silver for solar panels, is set to boost demand. Despite the challenges posed by the global pandemic, the silver market remains resilient, demonstrating its versatility and value. Let's shift gears to copper. The International Copper Study Group predicts a global copper deficit in 2023. This is due to increased demand from the electric vehicle and renewable energy sectors. Copper is a critical component in these industries, and this surge in demand, coupled with supply disruptions, is expected to push prices higher. Investors are keeping a close eye on this developing situation. In a broader context, the World Bank anticipates that metal prices will continue to rise in the short term due to strong demand and supply constraints. However, they also note that the situation may stabilize as supply chains recover and adapt to the new normal. In conclusion, the metals industry is experiencing significant shifts. These changes present both opportunities and challenges for investors. The surge in demand for gold, silver, and copper, coupled with supply disruptions, is reshaping the market landscape. As always, it's crucial to stay informed and adapt to these changing dynamics. Staying updated with industry news is crucial in this fast-changing market. Your thoughts and insights matter to us. As we delve into the fascinating world of gold, silver, and copper, we believe that the journey is made richer with your participation. We welcome you to join our growing community by subscribing to our channel. It's a simple click that opens up a treasure trove of knowledge. Don't just be a passive viewer. Make your voice heard. If you have any thoughts, insights, or questions on the topics we discuss, drop them in the comments section below. We encourage lively and respectful debates. Perhaps you have a unique perspective or a prediction of your own. Share it. Your contribution could spark a new discussion or provide valuable insights to others. Remember, knowledge grows when shared. So engage, interact, and become an active part of our community. Thanks for watching. Please write in the comments "I subscribed," and we will get back to each of you individually.